Everyone. Thank you all for joining, and thank you to David for sharing his time. Anyways, we'll kind of hop into it real quick. But yeah, David, if you want to, I guess, kick it off, we'll just do, this is kind of open-ended. So as questions, you think of questions, feel free to put them in the chat and we'll address them as we go. But David, if you would just kind of introduce yourself and then we'll take it from there.
Thanks, Dustin. My name is David Priest, Pradas Commercial Group. I'm here in the Woodlands, Texas, so just north of Houston. I'm a Houston native, so I've lived here my whole life, and this is kind of my specialty is definitely this market. I got into real estate originally about 20 years ago, but that real estate experience was all transactional. So I got in the mortgage business around 2003, learned that trade, decided to go out on my own in 2008. Very interesting time to start a mortgage company. Got through the financial crisis and did really well. I decided I wanted to do real estate also. So I got a real estate license and started being a realtor along with being the mortgages. Did about $500 million in mortgages over 20 years. So that was kind of my primary thing. So I have a lot of experience in underwriting deals and got married in 2008. And I'd been investing in the stock market, and obviously it crashed right after we got married, but we started putting a lot of money in those markets. But I didn't really get into real estate as an investor until 2023. So I didn't do any single family. I still own no single families besides my primary residence. So my journey was very different because I skipped single family completely because I didn't want to manage properties and deal with the repairs. I'm not a handyman. I don't know how to do all that. So my journey was quite a bit different because I skipped the single family part of it that a lot of people go through.
Awesome. Yeah, that sounds that's interesting. Yeah, because a lot of people do start off on the single family side, and but obviously you don't have to. So what I guess how did you kind of hear about multifamily, and how did you kind of get into the space initially? Did you start going to conferences or meetups, or what did that look like?
Yeah, originally I just wanted to be a passive investor. So I mean, I was going to be a passive investor. My wife and I had been on like a streak as far as the stock market from 2009 on to 2020. My wife thought I was a financial genius, and I said, "Well, this is a really good, like the best, longest bull market in history, and it's not
Yeah.
going to last forever." But we did really good. We did bought a lot of index funds, and we were living off my wife's income at her oil and gas job, and we were saving all the money for my business. We had a really high savings rate. COVID came along, and we got shaken out by that because it was the stock market got cut in half for about 3 months,
Wow.
and I saw my net worth get cut in half like just instantly. So coming out of that, we didn't sell anything. We held on. It did come back, but I told my wife we got to get into real estate, but I was still afraid of buying single families, although my best investments, as far as multiples, had been real estate. My house I bought in 2008, I put Fannie Mae zero down. I put $500 in the deal, and I walked out of the closing in 2016 with $60,000. It's 120x. I had a great place to live, and so I bought a house here in the Woodlands in 2020, and that house had gone up. So the inflation happened, and I was hearing about a lot of distress in multifamily. And I actually, to me, that got me curious because, I had the same experience during the financial crisis with stocks. So when people say there's a crash or a problem and things are really cheap, I started getting interested. So I basically started trying to learn as much as I could about it. I didn't know what a syndication was. The first person I talked to about a syndication, he was from New York. He had kind of a strong, like Bronx accent. I thought he was in the mafia. I just had no idea what he's been talking about. And it showed because I had been doing, remember, real estate for 20 years in the single family. I was a real estate broker. I'd done hundreds of millions of dollars worth of mortgages. when I got into commercial, I had to start over again. I knew nothing. I was a complete amateur. So if you're at that level in your journey where you're like, wow, I don't really know anything, don't feel bad about that, because everyone, when they get this commercial space, it's a whole new animal. So I was going to be a passive investor originally, and I was looking into this. I had a little bit of a detour because I got leukemia in 2022. And that was a real important part of all this, because I started getting interested in going to conferences and learning everything. And I got through the cancer. I'm healthy now. I'm fine. It was a really important part of my makeup and my mindset, because I realized life is short. You're not always going to be able to do what you want. And you may not have 20 or 30 years to get to where, you want to be. So that was a real important ingredient. And I started going to conferences and immediately realized, wow, these people at these conferences are really cool. I kind of think I found my tribe, and I'm around a whole herd of unicorns. And so that was interesting for me. And I started doing some passive investing, but I decided, hey, I think I want to, get in as a general partner and start going out and buying deals. So that was kind of my first introduction to it.
Gotcha. Okay. And yeah, so appreciate that summary. And so what did that, you kind of did a good lead up to it, but what did that first deal look like for you? It sounds like you invested, you were passive in some deals, and then you were wanting to be a GP. What did that first kind of GP deal look like, or did you do a fund, or what was your thought process before, go down this, this road or this road as far as fund
Well,
manager GP?
it definitely wasn't even, because my first GP deal was a total disaster. It was my disaster. So I
Hmm.
was looking at doing passive deals. The market was getting worse and worse. I was hearing how bad it is, and I was like, well, maybe I need to jump in and do that. And so I've been told by people. I got in a mentoring group, and they told, go out and buy a small deal, buy a 50 unit. And I thought, well, I can go do this. I was going to go and be a do it all. I had come from, in my mortgage business, I was a solo operator. I had an assistant. I did everything myself. So I thought, well, I can learn all this stuff. So I spent about a year learning underwriting, looking for deals, doing every single thing I could to kind of do it myself with my wife. We got a deal under contract in late 2023. And so I was going to immediately jump and do like a GP deal. And it was like a 90 unit here in Houston. Pretty big deal for a first timer. And no single families. I'm going and buying a $13 million deal. Thought I had it like wired. I had a, KP that was going to sign with me. He had a ton of real estate under management. Thought the loan would be no problem. Got into the deal, and everything started going wrong. So I immediately found out you should really just be on the bus with really experienced people, and don't go to try it and do it yourself. And so I had some money at risk. Eventually, we went through a couple of KPs, because my first one was in trouble with Fannie Mae. He was on the A check list,
Hmm.
and he could not get any more loans, and he was my go-to guy, and I really didn't have a backup plan. And
Oh,
so
wow.
yeah, so on that first deal, we ended up, everything was going wrong. The financials kind of deteriorated. The seller didn't want to work with us, so I ended up walking on that deal.
Hmm.
So that was a loss. Pretty lost a pretty good chunk of money. Money had gone hard. There's pursuit costs. When you walk from a deal, you're going to lose money. It was my own money. Now, what happened that was really good out of that was I got like kicked in the ass a little bit, which was great. I got a lot of humility. I can't do it all myself. But in the meantime, I had been raising money for the deal, and I had to send all the money back. So I
Hmm.
started realizing, well, what went, this was a mess, but what went really well? The capital raising was pretty good. So
Okay.
I decided, hey, I need to really kind of focus on maybe the capital raising. And everyone's saying how hard it is to raise money for these deals, and everyone needs money to do these deals. It's the main ingredient. You need money to be able to close on these deals. Where the source is on that. So I'd sent the money back. So I put out the word that, hey, I'm available. I can raise money for deals. And what was really interesting is one of the last KP that actually we probably could have gotten the deal to the finish line. I mean, I called one morning and said, I don't feel good about this. I think I should walk on this deal. And he's like, are you sure? Because I mean, we can,
Yeah.
it's done. You're going to lose money. And I said,
Yeah.
yeah, I know I'm going to lose money, but I feel like this is the right thing for me to do right now. I feel like if I go forward with this, I'm in a space where I don't feel comfortable with it. And I think this is the right thing to do, even though it's hard to take that bitter pill of losing money. So he called me back about 3 or 4 weeks later and said, hey, I have a 296 unit under contract. Can you help me raise money on this deal?
Hmm.
And he threw a number out that was a pretty big number for me at the time. I was like, I don't know if I could do it. I remember, of course, saying yes. This is like, I can do it, no problem.
Right.
Getting off the phone and being like, oh my God, I'm kind of having a little bit of a panic attack here. I'm not sure if I could really
Yeah.
do that much money. So I got on that first deal with him, and it it was a big comeback. So within like a month and a half, I had raised to 7 figures on my first deal. I was a
Wow.
GP on a 296 unit, and strictly just because I didn't quit. And I taking action on that first deal had me meet the person that I got that first deal on. So it was all part of the
Mm.
process. The other
Yeah.
thing too is I had lost money on that first deal, so I knew it was like to lose money. I knew how much it really sucked, and I
Yeah.
think as a capital raiser, having that experience, it really ingrained in me: be careful on these deals and watch out and protect your investors. I know how much it sucks to to raise money, to lose
Yeah.
money like that. And my wife had also put me on notice at the time, like, don't let that happen again. Like that's a one-time thing. She was very supportive, but she said, hey,
Yeah.
don't let that happen again. Let's do something. And so the capital raising for me was better because I wasn't putting my own money at risk in the beginning. I get the sweet part of the deal. I know all the
Mm.
blood, sweat, and tears that goes into acquisitions and due diligence and finding deals and putting money out there to buy the deal. And then when I get it, it's the sweet spot. A lot of the hard work's already been done. It's a beautiful deal, and then I go out and I go to work at that point. So that for me works really, really, really well. And I don't have to build a huge team because the people that are doing everything, you've got to build these big teams, which is great. I respect that. But I like the fact that I don't have to do that.
Yeah. Well, and I think it's smart for you, like you're like, hey, there's a few swim lanes here, and hey, I'm gonna try this one and this one, and then you're like, okay, well that was not fun. Forget that swim lane. I'm gonna stick to this one. And so I think it's smart for you because I think a lot of people spend a lot of time trying to and I think you do need to have some level of of understanding underwriting and things like that, but like you don't have to be a master of all these things to be to be able to participate. So yeah, I think it's smart for you to, hey, this is my swim lane and I like this, and it sounds like you've had some success pretty quickly, and that's pretty, that's pretty impressive. I'm kind of stating this also for some of the people on some of the audience and all that to for your first deal to raise $1 million+ is it's not an easy feat at all, and so what do you think led to you, raising that $1 million for your first deal? Were you doing a lot of coffees with people? What kind of led up to, did you already have a huge network? Like, what did that kind of look like for you?
Well, I had been building that network, but the network that I built was mainly focused on other real estate professionals, which, as you know, are not the best people as passive investors because they're keeping powder dry for their own deals. I get that. So
Yep.
I didn't have a huge network. I was a member of an investment club here in Houston, Total Wealth Academy, and that
Mhm.
helped because I had access to those people, and I was going to a lot of regular meetings. I was getting known. I was trying to get out there as much as I could, but on that first one, my network was really not as big as I wanted it to be. And that summer of 2024, I started changing everything that I was doing from, when I go to conferences, obviously you're going to meet other people, other operators and things like that. That's kind of a natural thing that happens,
Mhm.
but it's not really your best go-tos for investors. So I
Yep.
started focusing after that first raise on educating investors, trying to get people that were really first timers, because I think that that's the magic is you can find people that are, hey, I want to do this, I don't know how to do it, I don't know how to get in these deals, I really need to understand these deals. So I started doing a lot of education. I started going to a lot of events that weren't just your standard, real estate conferences, looking for people that were business owners or looking for people that would be good real estate investors, maybe looking for people that were single family people that had a large portfolio and they're starting to whittle that down and go more passive. Maybe they're older. I've several people I deal with that are older and they own a lot of properties and they're like, hey, I'm 70 years old and I can't manage 40 properties anymore, and I'm starting to
Yeah.
sell these and be more of a passive investor. So started looking for that passive investing, and once I focused on one thing, which was the capital raising, everything else clicked.
Hmm.
But my experience trying to be an operator was great background. So I spent over a year studying underwriting, studying acquisition, studying due diligence because I was my training, because that's what I thought I was going to do. So I kind of had a master's degree in all the other stuff. So that helped a lot. That was really, really important. Even though I wasted a year, maybe technically, and I lost money, friend of mine told me, hey, 2023 was a great year to waste and not buy anything because the prices were going down at the time. So he said
Yeah.
that's a
Yeah.
good year to waste. So I felt like the timing was right and things worked out in the end. But I mean, it was not an easy road.
Yep.
Everything didn't go according to plan, definitely.
Right. Yeah. And so that so you raised a good bit of capital for that first deal. And then I don't know how many deals you've done total, but what did that, did the second deal, was it more challenging? Because it could be tough to kind of reload because to your point, you didn't have this huge roster of investors or anything like that. And so what did that second deal look like for you?
Yeah, it was challenging because I came off the seven-figure raise on my first deal and I was all excited. I was like, wow, this is great.
Yeah.
And then my whole plan was I was going to immediately jump on another deal immediately. Like 2 weeks later, I'm jumping on another deal with a different operator
Yeah.
and I'm
Yeah.
ready to go do the same amount of money. And it didn't work out as well in the second one because
Yep.
I squeezed the oranges pretty hard on the first one. So there was as much juice coming out anymore,
Yeah.
and I
Yeah.
hadn't really built my network back up and given my investors a rest. So I kind of went back on the second one. The raise wasn't as good. I started working on the education, trying to build my network out and did more of that. And the raise was fine. It was good. It was acceptable. It just wasn't what I thought it was going to be. And then
Right.
at the end of
Yeah.
the year, I did another one that was my third one. And that one was good. And what was cool thing about that one, it was a smaller raise.
Hmm.
And the person that I'd done the first one with, he invited me on that deal with him and another partner. And I was the only person from that other really big deal that returned. So he felt
Oh,
comfortable working with me and he knew I was reliable and I could raise a decent amount of money. So that felt really
yeah.
good. So I
Yeah.
kind of finished off the year with that. And then 2025, I did about four deals so far in 2025. One of yours, obviously.
Yeah. Yeah. Awesome. Is there, I guess, as far as activities to kind of build up your network and all that, so you've done a lot of education. I know just following you on social media and all that, you've been pretty active posting on LinkedIn and all that. Is there any one activity that you've seen that you think kind of moves the needle the most out of those different activities? Because you're pretty active, at least
Yeah.
from what I'm seeing.
I try to be everywhere. So
Yeah,
anything you can do that gets you in person with people is, I think, the key. So
yeah,
anything that I do that's marketing, I want to get in person with people if I can. If they're not in Houston, obviously I can't. You can do a Zoom call or whatever.
yep,
But I
yep,
want to be able to meet people, shake their hands, talk to them in person, go have lunch with them. Get in front of people and get face to face with people. So I do as much of that as I can, and everything's really focused on that. When I do education, obviously I'm doing that via Zoom or via some kind of online event just to make it more convenient for people. I do a lot of speaking also whenever I'm invited or I have time to do it. So just really just being like out there and kind of being everywhere. And
hmm,
and even if you're tired or don't feel like it, you're like, okay, I got to put a suit on. I got to go over here and go over there, and you just kind of show up no matter what, and you get known as, you've always got something going on. And so, but the education part of it is really, really huge. That's the thing I'm really passionate about, is helping people understand this stuff, because I want more investors, but also I want investors to really understand what they're doing. I think, like, as an LP or passive investor, if you can get enough knowledge and experience to where you really could be a GP if you wanted to be, that's where you want to be. You want to really understand this stuff. And I love it when I have investors that ask me a lot of questions. I'm like, this is great. They're asking a ton of, these are some tough questions. They're asking me hard questions. I
Yep.
feel better
Yep.
about that because I feel like they want to really understand the investment. It doesn't bother me at all. So it's
Right.
a good
Yeah.
thing.
Awesome. Sounds good. And I guess whenever you're the reach out to, so when I first started um in multifamily, like I didn't have my first webinar. I did my first deal in 2014. I didn't do my first webinar until 2018 or 2019. Like people just didn't do that.
Right.
And so I remember I would send out an email and it wasn't even, it looked terrible. Yeah, if I go back and look at it, it was a one pager and that was it. And I'd, pull in money and send out docs and it was, kind of done. But a lot of it was, those in-person meetings like what you're talking about. It's tons of lunches and phone calls and all of that kind of leading up to that deal. Once you have the deal, you should have already had all these conversations. um, but is there anything, I guess, have you seen it's gotten more challenging? Like you can't just email people now and expect a bunch of dollars to roll in. There's
Nope.
other, texting, calls, and all, in all the above. Is there anything that you found has been, pretty, I guess, a good channel for you to get a hold of people? I don't know if you're a big texter or email or calling guy, but just curious what's worked for you.
All of the above. I mean, I like to get on the phone with people if I can. So generally, like if I'm raising money, it's no secret. I mean, I'll use my email list to set up a webinar, and I'll do some social media if it's a 506c, and I'll send out a few emails to my full list, and then we'll see who shows up for the webinar, who registers. And then
Yep.
that's kind of my hot list that I'm going to work on, that I'm going to call. Even if they didn't attend the webinar, I do recordings. I post it if it's a 506c on YouTube, and I follow up with people based on that list. I figure the people on the webinar are interested, and
Yep.
they're ready, or they've got some interest. Maybe some are learning, some are just curious. But I mean, that's kind of my go-to list, and then I kind of ignore everybody else unless I hit a stopping point. I'll usually do two webinars, and I learned to do webinars during like COVID, because it was like my mortgage company, I couldn't go meet people in person anymore, so I
Hmm.
had to start doing Zooms. So I kind of already developed that skill a little bit of putting those on, and it's a really good way of reaching. And then if you're doing a recording, if you have a 506c, you can do a recording and post it YouTube or post links or whatever. So it is a really effective way of having it work when you're not. Sometimes when people are really busy, I call as much as I can, but if I know people are super busy and it's a person invested before, I may text them, or I may follow up with a text after I've called, or whatever. So it's whatever is, effective. And I try to keep tabs on different people and what they respond well to. So I don't bug
Okay.
them. If it's a surgeon, they probably don't want me to call them at 10 o'clock in the morning, if they've
Right.
into
Yeah.
somebody.
Yeah. Yeah.
Yeah.
Yeah. Yeah. um, is I guess kind of switching gears just a little bit. What do you look for in a deal? What do you look for, whenever you're looking at a sponsor? What's some, criteria? Do you have kind of a checklist? What does that look like for you?
Yeah, 100%. So first of all, whenever I'm raising money, I'm always putting my own money in every deal. So I
Hmm.
always put, minimum, sometimes it's 100,000, whatever it is, I'm going to put in a significant amount of money into every deal. So that's the first thing on my checklist is this a deal I want to invest in personally? And if it isn't, then we're done right there. But the
Yep.
method I use, and I have this on my YouTube channel, I call it the DEAL method, which is an acronym. And I'm going to write a book called that
Oh,
eventually.
cool. Cool.
Yeah, yeah. So the deal method, it's an acronym. So D is for debt. It's the debt structure. Is
Hmm.
it fixed rate debt? Is it really complicated? Is there a lot of debt? Is there mezzanine and pref and a lot of things I'm not sure about? I've got to do a little bit of research on. I won't do any bridge debt deals. So when people send a bridge debt deal to me, I look at it. Well, the place is rough. It's bridge debt. I'm done right there. I'm like, no, it's too risky. I don't want to
Yeah.
invest in this. So I look at the debt structure first. Then the E is the experience of the team, the GP team.
Hmm.
So there are like probably three or four different types of teams. There's people I've worked with before that I'm totally comfortable with, had success. There's people that are on my list of like people I don't really want to deal with that I kind of know what's going on with them, or maybe I don't like to work with them, or I don't like the way they're structured. Then there's other people that I've never worked with before, and I kind of need to check it out a little bit.
Hmm.
So I mean, there's people I've never heard of before. So
Right.
I
Yeah.
kind of look at, but that experience of the team, I want at least one person on the team, 10 years in multifamily like you. I want
Hmm.
people that have kind of seen different markets, have been through the storms. When I talk to people, I always ask them, well, what kind of trouble are they having? What kind of, issues and how have they worked through it? And if people have a big portfolio and they tell me everything's great, I'm like, well, it's a really good lunch, and I'm out of there like fast. I know they're not very honest.
Yeah.
So
Yeah.
I look at the experience of the team. I want people that have been through it and kind of been there and done that. You really can't have too much experience. If I could find
Hmm.
people going back to the financial crisis, that's great. It's just there's
Right.
not a lot of those
Yeah.
people around anymore. But so you look for that, and then I actually look at the L next, which is the location. So I'm skipping A. A is the accounting, is the numbers. So I look at the location in the market next. So unlike most investors, I look at the numbers last
Hmm.
after I looked at everything else. So I'm trying to eliminate stuff. Okay, the debt structure, it's bridge. I don't like it.
Yeah.
This GP team, they're rookies. There's nobody on the team that's ever, this is our first deal or their third deal, and they haven't gone full cycle. I don't like that.
Yep.
The property, it's in Madison, Wisconsin. I have no idea about this market. I don't want to invest there. So I go through that checklist really quick. So I can usually say no in about 5 minutes, like on any
Hmm.
deal quickly.
Wow.
And
Yeah.
then if I like the deal, then I'll start looking at the numbers. And I'm really looking at the numbers from a perspective of, does this make sense? Is it reasonable? So on a fixed rate deal, is there, is there too much leverage? Are they promising too much? Is it too optimistic?
Hmm.
And so I'm looking like numbers that are outliers that look really too good to be true, like they found an amazing deal. Those deals scare me a little bit. I'm looking more at the safety of the deal. I'm looking at, like, on your recent deal, the Henry at New Forest. Okay, we had recent comps of per door, and then that property is about 25% below the 2025 comps. So I want to see that.
Yeah.
Okay, this is a deal we're buying. We're buying much cheaper than the comps. I get real interested,
Yep.
real quick on something like that. But I like management value add. I like a simple business plan. I like it when you're buying from a distressed seller, but because of the debt or whatever decisions the seller made, but the property itself is not distressed. It's a
Right.
sweet
Right.
property in a good location with high occupancy, and you're getting a really good deal. Those right now are really, really the sweet spot. I don't think you have to take a lot of risk right now to do really well in these deals.
Yeah, yeah, that's a great point. It kind of reminds me of a deal. So we Hayden and I offered on it, and not that so all the offers were below the loan balance, and this
Mm-hmm.
is in Dallas, and so we were interested in it. It's a great location, but to your point, there was nice location, but there was, there's a lot of, their loan was due and all that. And it's just not, their operations have really, tanked, really head downhill. And so we just weren't comfortable, the cap rate that we were buying was terrible. The price per door was awesome, but the cap rate that we're buying was terrible. And, to your point, just we're like, hey, if we could get it for our price, we were very comfortable with that. But there were others, other people in front of us. We're like, okay, well, it's all yours, go for it. It's not a deal where, we're going to push like at all. So, anyways, but yeah, and it's interesting too. Yeah, I like, we like those type of deals too, where it's everything, it's running well, and it's like, oh, they're out of time, their loans due or whatever, and so, and there's been a few of those. That New Forest was newer deals, so it wasn't necessarily the case, but we've seen some other deals where people have put in, because they were on a bridge loan and they were financing the rehab, so they put in millions and millions of dollars. The properties are in really good shape, and so we get to kind of step in at this lower basis. Their equity gets wiped. I mean, it's a really really good scenario. Um, anyways, but and so you have your deal method, and is that, I assume this is something you've just kind of developed over the past few years, and probably some of the experience and some of the things that you've heard as far as like some oh, bridge loan, that could be that could be troubling and all that. Is I guess kind of looking forward, going into 2026, what are you kind of, I guess in deals, are you sticking mainly to Houston, or are you looking at other markets as well? What does that kind of look like for you?
I've done a couple of deals in San Antonio, and I mean, obviously, on paper, the best market in the US is Dallas Fort Worth, if you can find a really
Mhm.
good deal. I think the
Yeah.
biggest problem with it is it's the hottest market in some ways too.
Yep.
So finding deals with positive leverage is hard. So
Hmm.
you look at your cap rate and what you can get debt for, and you want that spread to be as much as possible. And you can find that in, say, Houston or San Antonio a lot easier.
Hmm.
With Dallas, you can't. With
Yep.
Austin, it's really hard to figure out what's going on over there. It's like it's up, it's down. I mean, it's
Yeah.
really hard to underwrite.
Sideways. Yeah.
But in the other three major cities in Texas, I mean, Dallas is probably the hottest one. So if you can find a really good deal that makes sense, it should be good. It'll be very easy to sell. The
Yep.
insurance and obviously is a lot cheaper up there than Houston. So that's what I look for. So I've started to favor newer properties, more class A, like the deal that we did, because I'm seeing on those properties there's a lot less delinquency. They're easier to manage. There's a lot less problems. Now
Yep.
I've done a few 80s products that were, like you said, that were on we came coming off a bridge, and they
Hmm.
were beautiful properties. Like what had happened is the first deal I ever did, they bought it in 2022 in January on bridge. So it's like
Hmm.
the worst possible time right before the rates totally escalated. And
Yep.
the guy was an awesome construction guy. So he was going to try to renovate these units really quick and then raise the rents and outrun the escalating bridge debt. So he spent $3 million on the property in capex, and the property was like for an
Oh,
80s
wow.
was spotless. So basically, when the loan failed, the bridge lender just wanted their money on the loan. So we were getting it for like a little bit under $23 million, and it sold for 31 million,
Oh,
2 years
wow.
ago. So it was like a 30% discount and getting the 3 million in capex, having a beautiful property. So those kind of deals, if you can get those are great. But like I said, I would not buy a property now that needs $2 or $3 million in capex. It's just too risky. It's too difficult with construction costs, tariffs, labor. Those really high flying, value add projects. Those are really, really difficult to execute on right now. And there's so many other great properties that you can buy for a song that are
Yep.
debt stressed, that are beautiful properties. And why not buy more of institutional grade, and also be able to maybe buy more properties because you're not going in and doing the heavy value add, which takes a lot of blood, sweat, and tears, and it's a lot more difficult on this type of deals. I think it's better to go for stuff that the property's really nice. It needs to be recapitalized. It needs new fixed rate debt, and you just go from there.
Yeah, yeah, no, absolutely. Yeah, it makes a lot of sense. Yeah, we've seen, other deals, other 80s deals in Dallas, that, we've seen some where they put a lot of money in. It's just a a loan issue, and it's running just fine, great cap rate and all that. But we've seen some others that are honestly a complete mess. It's a falling knife situation, and so it's not only bridge loan, but then if you look at your economic vacancies, terrible, and so anyways, it's just when you're looking at risk adjusted returns and all that, and honestly, what you want to spend your time on, and like you said, there's a ton of deals right now. I don't know this number. I think I'd mentioned this to you. I don't know this number for Houston, but I know or this time, but I know in DFW the peak foreclosure period is supposed to be kind of mid next summer.
Hmm.
And so, I think, obviously with that being the case, there's going to be a lot of opportunities, in both Dallas and Houston and, kind of everywhere over the next, at least 12 months, maybe 18. I don't know. It depends on where, if interest rates, if we do see a drop, which, looks like there'll be, cut, I guess. I didn't see if there was one today or not. I think there was supposed to be, but it looks like they're, maybe not going to be cutting, or at least not for the next few months is what they're
Yeah.
kind of
I mean,
predicting. So,
you have to have, I mean, the lowering interest rates will definitely help and
yep.
it'll bring more buyers in. But
Hmm.
how many buyers are there right now that are in great shape that can go out and execute on these deals and they can get debt and they can raise money and they can go do a 30, 40, $50 million deal? It's really kind of limited right now. And
Yep.
people jumping in the business can't go out and do this kind of deals right in the beginning. So there's a
Yeah.
really limited pool of buyers out
Yep.
there that are ready to go.
Yep.
And that's
Yep.
it's important to be involved with people like you guys and with Hayden that can execute on those kind of deals because there's not
Yeah.
a lot of people out there that can right now.
Yeah, yeah. To your point, I mean, I'm sure you've talked to brokers and all that a little bit too, but half of all deals that are go under contract, they don't close.
Right.
So like we're getting callbacks right now on deals we offered a few months ago where they're falling out of contract, and they're like, "Hey, you're still interested?" And so we're anyways, it's a very very interesting time right now for sure. Is so you've raised on four deals this year, and then I think you said a few deals in 2024. Are you as far as next year, or do you have kind of a pace that you think would work for you, or you want to do one a quarter or a little more than that or a little less, or what do you think 2026
Yeah,
looks
I
like
haven't
for
I
you?
haven't totally figured out yet because I'm partnering with different people and I'm kind of figuring out how these partnerships are going to work and how much money we can raise.
Uh-huh.
And then if we get where we can raise quite a bit more money, which is what we're working on, do we want to throw huge numbers and do fewer deals, or do we want to kind of spread that out a little bit and not put too much in one deal? I mean, if you can raise $10 million, do you want to put $10 million in one deal, or you want to kind of, spread
Right,
that
spread it
around a little
around.
bit? But I
Yeah.
mean, not to be
Yeah.
too confusing. So, I mean, I'll do a minimum of four or five probably, but I might
Yeah.
do more. And I
Yeah.
think this is really the last. I mean, I think 2026 is really the big opportunity. I mean, I think by
Yeah.
2027, one of two things: the market will either get a lot better or rates will get a lot lower, and it'll really put a
Mhm.
floor on things. And I think right now you're seeing like prices were really going down in 2024, but in 25 they really just kind of flatlined at a bottom. So
Yep.
and it's actually good because if it had started going back up again, you have like a trough, but it's been flatlined for a long time.
Yep.
So there's a lot of opportunity there to keep buying stuff. But once you see that tick up, everyone's going to kind of jump back in. And you could have a lot of institutional money too. Like your
Right.
big players, your BlackRocks or whatever, they jump in and start throwing billions of dollars around because they think they missed the bottom or whatever. And a lot of that money's being held back right now. So that could put a floor on it too. So I
Yep.
I think 2026 is the last opportunity. And I think you get to 27 or 28, people that were buying stuff 24, 25, 26, everybody's going to wish they had been buying more, and everybody's doing the best they can right now. But I think the lack of development the number of people moving into Texas, eventually the rents have to go up, and you're going to
Yep.
see at that point.
Yep. 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 Yeah. Right now, people really can't factor in, rent bumps at all because no one's no one's really seeing it. So it's been pretty flat. So and then I wanted to just for everyone that's on the call too, if you have any questions, feel free to you can unmute yourself or if you want to put in the chat, either way. But feel free if you have any questions for David while we still have him for a little bit. So and then I guess as far as so you have some different partnerships and then probably doing 4 to 5 deals next year, if not more. Are you, I guess on your end, because I know you've done, I think some multifamily, but you've done other asset classes as well?
Yeah, this summer I did work on a storage deal that was kind of a one-off because I like the operator a lot. I'd invested with him, and it was $100 million deal here in Houston, and so I was
Oh, wow.
really jazzed about being part of that. And he called me and was like, "Hey, will you do this storage deal with me?" And it was really good. So I probably won't do any other asset classes right now, because on that storage deal, it was more difficult for me to raise on. I'm not an expert on storage. And
Yeah.
it was like a thing where I got out there and I kind of stretched out a little bit, but I don't think I
Mhm.
would do it again. I think I'm just going to stick to multifamily because I'm so comfortable with it and I like it. And also the prices with it being down, say 30%, I just see the huge opportunity there. I see
Yeah.
that's more of an opportunity than any other asset class right now. You could probably make an argument that office is more distressed, but I don't know who in office is going to make money. Somebody's going to make a lot of money. I just don't know who that is. But in
Right.
multifamily, I know people need to live somewhere, you
Yep.
know, and I believe in it long term. I always ask people, hey, tell me one thing besides office that is, 30% cheaper than it was back in 2022, with all the inflation, everything we've had. I mean, there's
Right.
nothing in the world. It's like the only thing besides office. So I know people have to live somewhere, and I know there's not a lot of development. So long term, I feel very comfortable that the prices are going to go up.
Right. Yeah, it makes a whole lot of sense. Dan asked if you had any specific geography that you favor.
Texas Triangle. Yeah, I mean, it's all Texas. That's all I'm doing right now because I'm really an expert on Houston, but I'm definitely comfortable with Dallas if we find a good deal. And I've done a couple of deals in San Antonio. The only place in Texas I'm really not comfortable with is Austin because it's topsy turvy. It's a little bit of a roller coaster ride, and I don't really understand that market. I can't figure it out. I'm comfortable with San Antonio. Houston is, I'm really an expert. And when we find a good deal in Dallas, I'm definitely comfortable with that. It's a great market. Those are the big three because of the population growth. And all this areas is great. People are moving to Texas. So I generally don't look at any other states at all. I mean, I've had people send me deals from all over the place. And I'm like, I don't know anything about these places. And also
Yeah.
my investor base is really Texas focused. So it's a lot easier to sell them a Texas deal than sell them a deal in another state.
Yeah. Gotcha. Okay. Awesome. And then I guess it just digging into because I know you said numbers kind of the last thing you look at. Any specific, cash on cash or just kind of IRR or just metrics that you're looking for in a deal?
Yeah. So the one number I look at initially, right in my screen, it's really under the debt screen, is the initial DSCR. So
Hmm.
does this cash flow immediately? I want to see a DSCR right now of 1.25 or higher. So it's gonna cash flow from the get go right away. And then obviously we have a plan to raise rents or do some light value add or something to make those go up. So that's the first number I look at. It's cash flow or no go with me. If it doesn't cash flow
Yeah.
for, I think Robert Kiyosaki said that one time. So that's me. Robert
Yeah.
Kiyosaki, don't do the cash flow. I don't want it.
Yeah.
So when I do a deeper dive in the numbers now, if the debt structure is fixed rate debt, and I know it cash flows day one, I know the operators are really, really experienced, and we're buying a great property in a good location. Well, the other numbers are going to make sense.
Right.
So my
Yeah.
biggest concern looking at like IRR, which is very easy to manipulate, is I'm looking for stuff that's too optimistic. So,
Right.
so generally in this market, if I see an IRR that's maybe over 21 or 22, I start thinking, okay, this is getting a little bit optimistic.
Yeah.
And
What's red?
yeah,
Yeah. Red flag.
my biggest worry is, okay, so I'm selling a 25 IRR, let's say, on a presentation, and then we go and we kill it and we do a 19 and we did a great job. But the
Yeah.
people they didn't get what they wanted, so they're going to be disappointed. I would much rather have a 15 or 16 IRR and a super conservative business plan. We're attracting people that are conservative. We're trying to protect people's principal. We're trying to be super safe. And then if we X early, maybe we do have a 25 and then we're superheroes. And that's fantastic. It's
Yeah.
great. But I mean, I had problems before right in the beginning because I was in that right in the cycle of people that were coming out of some home run deals in the early 2020s, and I would have deals that were an 18 19 IRR, and they'd be like, well, this isn't good enough, I want a 25 or a 30 or whatever, I won't invest in it. And I'd be like, well, you can look at the business plan, and if you can find a way for us to take more risk and make more money, we'll bring you as a GP. But I don't see it right now, you
Yeah.
know.
Yeah.
So
Yeah.
I'm being more careful, but I do think the more experienced operators, as people become more seasoned, they're more careful. They have confidence in their abilities, but they know stuff's going to go wrong, and they're a lot more careful. So generally, you're going to see right now on fixed rate debt, if it's not over leveraged, a 15 to 20 IRR. And if it's below 15, then I'm like, well, this isn't a good enough deal to even look at. And if it's over, say, a 22 or 23, then I'm like, well, it's not going to be that good of a deal. And we're over promising and we're probably going to under deliver. So I look at that.
Yeah.
Equity multiple is something that really can't be fudged with too much. So I like equity multiple because IRR can be really manipulated, but equity multiple, if it's a 2x, it's 2x, it's
Yep.
pretty good
Yep.
unless they have the return is too short of a period. I want the business plan to be 5 years or more. And I really like the debt. The sweet spot is kind of like 7-year debt. I think 5 years fine. If people can go 10-year and make it work and they're going to hold the property long term, that's great too.
Yep.
But I don't do anything where it's going to be a shorter than 5-year term on the debt. And, rent growth, like I said, the first year, you need to look at it being almost flat and maybe 3% after that. And then on expenses, even if you have a way to cut expenses, let's say an insurance policy, I think you underwrite the expenses to be flat too. If you think you've got a full, because then if something unexpected happens, you've got margin to make up for that. And if it happens, so I think you're just being careful on the numbers. But when you look at the experience of the operator, it takes care of the numbers because they're the most experienced operators are pessimists.
Right. Yeah, that's true. Well, because they know it can go wrong.
Right. They've been there. They've been
Yeah.
hit before. They've got some battle scars. And so the people that
Yeah.
are rookies are
Yeah.
like, I'm gonna figure it out and it's gonna be fine. Well, yeah, you will figure it out, but it's not gonna work the way you think it is. You'll figure it
Yeah.
out, but
Yeah.
you're being a lot more careful. I see the more experienced operators, hey, we're doing longer term fixed rate debt. We're trying to buy nicer properties. We're trying to not have as I think inexperienced operators, they love the problems. It's like a challenge for them to show how impressive they are. And I think more experienced operators are like, let's not have all this bad stuff happen. Let's be careful,
Yeah. Yeah.
So
Yeah. We have gotten over the years to your point. Yeah, I remember the second deal I did was or no, third was in Oklahoma City. And Oklahoma City is great. I like visiting there, blah blah blah. But like I bought, and this is before I had access to, all the data and crime stuff and crime maps and all that stuff. And I just remember, driving by, I was like, oh, it kind of looks like, the area where I grew up in, just like, not huge homes, but just like working, kind of gray collar-ish, you know, like 1,500 square foot homes, type thing, 2,000 square foot, kind of in that range. And so, anyways, we got into that deal, and oh my gosh, the crime was, honestly a lot more than what we anticipated. And yeah, I mean there weren't bars on the homes, or it looked fine. There's like a Brahms down the street, but anyways, but yeah, that was a battle. It was really challenging. And just kind of some other experiences, like it's all about that location. And you can pour all this money into a property, but you can't change your neighbors, can't change your school. And I know people like to say they can change it from a C to a B or whatever. But if you have if you're trying to move it from a C to a B and you have C tenants, you're not moving it to a B.
Right. I
So
mean,
I don't care.
also, yeah, where your B tenants, will they move into that neighborhood? If they
Right.
won't,
Yeah.
if they Google it and there's crime, it's the first thing that comes up. It's a real problem I had when I was looking for my own deals. I was talking to a property owner and I was telling him it was a direct to seller, and I was like, hey, the crime looks pretty rough around them. The crime guys, he goes, well, it's not really that bad. It's just like property crime. And I was like, really? Well, I'm going to buy the property. He said, this is important to me. And so I kind of jokingly said, so you're
Yeah.
saying that like the tenants, they're just going to break into their cars and break in their units. They won't kill the tenants. They'll just break into all their stuff. So it was
Yeah.
kind of funny at the time. I felt kind of bad later. It's like it was kind of maybe rude to say that, but that's what was going through my head.
Yeah.
It's like, don't tell me there's a lot of property crime when I'm going to buy your property because it makes me
Right.
want
Yeah.
to buy it.
Yeah, 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 yeah. Yeah, it's funny. Micah had a question. When you look at asset bedroom count, do you prefer a good mix of one, two, and three bedrooms, or does it really come down to location and what the area can support? I'm happy to answer it or if you want to.
Yeah,
Either way.
that's a great question, and that is a difficult one to figure out because
Mm-hmm.
people will tell you on two bedrooms, maybe you have two renters and it's safer, and people can roommate up or whatever. If they get in trouble, they can get a different roommate. One bedrooms are like more loners, and so you don't, if the person loses their job, maybe they can't pay their rent. I think you've got to have an operator that really has analyzed this stuff, and also if they already own another asset in the area, that's a huge plus. Like
Mm-hmm.
on the deal we did, y'all own the property next door, so you really had the best market intelligence of anybody when you own the property next door. So that's where the operator comes in. That answer is probably different for different locations.
Mm-hmm.
So, I mean, I think it's 50-50. And some properties will have like three bedroom, and they've got a lot of
Yeah.
three bedrooms. And it's kind of like a play on unaffordable housing. People have three or four kids and they can't afford a home.
Yep.
So that can be good too. So, what do you think on that, Dustin?
Yeah, I again, like to your point, I think just kind of it depends. So I mean, there's some areas where like we're buying in that area, like the schools is a big factor, and so if that complex is all one bedrooms, that's a real mismatch. So, if it's, the schools are one of the big selling points, we want a good mix of twos and threes. I think just in general, we like a good mixture of ones and twos and threes. It's so interesting. It feels like, during the summer we have, maybe I'm exaggerating a little bit, but during the summer, we have tend to have lots of one bedrooms available, but no twos. And then, once school's in session, then we don't have any ones, and we got lots of two. It's always funny. It just shifts back and forth, kind of throughout the year, and then at least more recently because rents have been frankly pretty flat. If whatever we have a lot of, we're having to, kind of put up a concession to, try to get those moving. So,
Yeah.
but so to answer your point, Micah, really just kind of depends on the area, the game plan. There's some other which I would say kind of, your working professional, kind of inner city type of properties that would probably be more okay with, having heavier ones and twos and, don't necessarily need threes maybe. So, yeah, I think it just kind of depends on you just want to match your unit count with kind of your game plan and the area and just make sure all of that kind of lines up well. So. David, I don't want to keep you, but is there anything you want to before we kind of wrap it up? Is there anything you want to leave the audience with, or if you want to give your website or LinkedIn or whatever is best for you?
Yeah. The best way to reach me is on LinkedIn. So my contact information is on there. You can book an appointment directly with me right from my homepage on LinkedIn, David R. Priest. So it's very easy to find. What I would leave people with is right now, this is probably the best opportunity in multifamily ever. So in our lifetimes anyway. And I thought it was always the financial crisis. You know, I was always like, well, if I could just go back to the financial deals were so cheap.
Yeah.
And I saw a presentation by Charlie Young. I'm sure you know who that is. And he
Hmm.
was talking about how, no, this is a better opportunity now for us because he said back in the crisis, he said, yeah, I had a lot of deals that were in a lot of trouble and I couldn't raise money from anybody. Everybody was scared to death and banks weren't lending. And he's like, I couldn't go buy
Hmm.
anything. It was real hard to buy things because you couldn't take advantage of it. Right
Yeah.
now, you know, the flow of banking money is still pretty good. You can get debt, you can get
Hmm.
loans. It's a little harder to raise money, but you can go raise money. So you can go execute on these deals in a way you couldn't do during the financial crisis. That kind of changed my opinion on it. So if you want to get into multifamily investing, or if you think this is a good time, or even if you've gotten some deals that were a little haywire and they didn't go the way you wanted and you've been disappointed, right now with this cost basis down, say 30%,
Hmm.
I would put as much money into these deals as you feel comfortable as you can. That's what I'm doing. I've kind of pivoted out of the stock market completely, um, and done as much in multifamily as I can. So I think when people are scared and people are uncertain, that's the time to be putting a lot of money in. That worked for me really well during the financial crisis in the stock market, and I think it'll work really well now in multifamily.
Yeah, yeah, I agree. To I think that, in a few years, even if interest rates don't necessarily come down and all that, between supply and demand and all that, I think we're going to start to see some rent bumps. I'm very curious to see what leasing season looks like this year. So we're very interested in that. But yeah, I agree. I think it's a great time. And yeah, I've kind of heard similar that no one could get. Because I remember I knew a few people that bought complexes in kind of 2010, 2009, and all that. They had to raise. There was no bank. There was no loans. You couldn't get a loan, and so they had to buy smaller complexes, and they had to raise it all cash, and then they refied after a year or two to pull everybody's cash out. So well, David, really appreciate your time. Great seeing you. Looks like got a lot of really great books behind you there. But yeah, appreciate your time. And please reach out to David. Super nice guy, very knowledgeable, very sharp. So reach out to him. And yeah, just a great guy to be connected with. So hope you have a great day and appreciate it, David. We'll talk soon.
Thanks so much, Dustin.
All right.
Take
See ya.
care.
Take care. See ya, everyone. Good seeing everybody. Take care. Bye.